much for joining today. I'm very excited that we are now in week 2 of our Financial Accounting Fundamentals course. Hopefully by this point you've logged on to our course page. You've seen the other materials. Each week that we cover in the lecture, I will also be providing the PDF to the financial statements and things that we're working on. There are some general questions that I encourage you to work through. Again, keeping in mind the goal of this course is to really provide a really good foundation for the theory behind financial accounting, because in the real world, a lot of times it's just we're grabbing financial statements. What does the bank need? What do I need to have? But this is really the time we can dig in and learn some of that, why it is the way it is, which hopefully will make it a lot better when we get back to looking at our financial statements to better understand the setup. So again, last week what we did was the balance sheet. So we started with the balance sheet. We started with that fundamental accounting equation, which is one of the major rules in accounting is that assets always equal liabilities plus equity. So we did that last week. We worked through the financial statement of Sam Adams. So hopefully some of you took the time to read through, read the management part as well. At the front of the financial statements are always the management discussion and analysis, and then the actual balance sheet to see if what we had covered with the lemonade stand sort of transitioned into the financial statement. So this week what we're going to do is financial statement number 2, which is the profit and loss statement. So this should be, for most of us, one that we're a little more familiar with than the balance sheet. But we started off second just because we needed that fundamental assets equals liabilities plus equity in order to get to the profit and loss. So what we're going to cover this week is going to be understanding the fundamentals of the profit and loss statement in accrual accounting. So one thing I need to really emphasize here, what we're covering here is assuming that you're an accrual accounting business, as most companies, most restaurants are. So what that means is that we are not always following cash, right? A good example would be someone comes in to my restaurant, pays with credit card. I record that as a sale today, but I don't have that cash yet, right? Because I have to wait, 24, 48 hours until that credit card amount actually flows through my bank account. But it's a sale to me when I earn it. That's an accrual accounting model. If we were cash basis, then it would be when the cash was received. So if you're not sure, it may be good to just check your tax returns, because there is a box on your tax return that asks, are you a cash business or accrual? So again, we're going to assume that you're accrual. If you are cash basis, then some of this may not apply. But most of us are accrual basis. That's one of the rules of the generally accepted accounting principles is the accrual basis. So larger companies are always accrual, public companies. So that's really one of the fundamentals that we're going to assume for the purpose of this lecture. The next one is that we're going to cover as part of our outcomes is understanding a little bit about the different structure and organization options on my profit and loss statement. So again, depending on if you're kind of like, I don't want to deal with my own right now, I just want this to be theory, then this could be something we, benchmark for later. But at some point, a lot of times I get the question of what should my chart of accounts look like and what should my profit and loss statement look like? Keep in mind that my belief is that it should reflect how you want to see it. So obviously there are some structure rules, but ultimately the organization of your expenses should be in a way that fits your business. So we can cover a little bit of that. And then reviewing our own P&Ls are the changes that I would like to make. But the majority of this lecture is going to be about understanding the format of the profit and loss statement. And I thought a great way to do it would be to look a little deeper into the Cheesecake Factory. So I'm not sure if all of you are familiar with Cheesecake Factory, but it is a publicly traded company. It was actually founded by Evelyn Overton, who had a small cheesecake factory in Detroit, one location, mom and pop. She moved out to LA and the 50s, 60s. So her ultimately was just always very small. And then her son took over and created what we now know to be the Cheesecake Factory today. What's really cool is that, it was started off really small. So, a lot of us are kind of like, it didn't take off right away, or we're kind of still, where we were 5 years ago. I mean, keep in mind that, you know, a full generation and then ultimately turns into Cheesecake Factory. So really cool to see. And then, you know, by 1990, they've expanded beyond California. They went public in 1993, and by 1985, we're ranked 11th in the U.S. So I encourage you to look at some of his interviews. He's done a few, you know, not quite as many as some of the other leaders or founders, but there's a few out there, and he's very interesting to listen to, and seems to have a really good belief in company culture and things like that. But why would we study Cheesecake Factory? So when I was trying to think of who would be interesting for the profit and loss, I thought Cheesecake Factory is very interesting from a standpoint of us as understanding restaurants or being restaurant owners, is that they have 200 menu items. So if you go to the Cheesecake Factory, I think as restaurant owners, you probably cringe and go, oh, I mean, their menu is just, there's so many items and it always changes. And you just, I mean, it's great food, right? But it's not at all what we've learned we should do. And yet somehow they've managed to make it work, even down to changing their menu twice a year. So when we're looking at that and we're looking at a profit and loss, that would be interesting to see what are their food costs, right? Because that's kind of going against everything we've learned. So what are those margins that they're still able to get that we will see in the cost of goods sold? Okay, so going back to sort of the fundamentals of profit and loss before we get into the Cheesecake Factory, what is the point of the profit and loss? What is it trying to tell me? Well, the balance sheet was trying to tell us, you know, does this company, you know, meet the cardinal rule of assets equals liabilities plus equity? It proves that out. The profit and loss is summarizing our revenues and expenses incurred during a period of time. So what it's trying to do, whether we run a profit and loss daily, weekly, or monthly, is tell us what were the revenues and what were the costs for that period. Here is where it's really important to know that it's not cash basis. It's not the bills that I paid this month or this week. That will come later in our statement of cash flows. These are the bills that I owe for this week. So if I'm recording my sales for this week, I want to see what did it cost me to operate that week so that I can see my net income, right? The real purpose of the profit and loss is to tell me, am I profitable or do I have a loss, right? That's the point of this statement. So again, that matching principle becomes so important. And now that we have time, right, the one silver lining is that we all now have more time. This would be something really interesting to go through, because you as an owner know some of those one-off things that happen, right? I pay my insurance twice a year. I pay my property taxes every quarter. Those are those types of things that we really want to make sure that we're handling correctly on the profit and loss statement, so that what we're showing each month is a true reflection of what we earned that month. That's the goal. So again, revenue is when we earn it. Even if we're doing a catering job and somebody, you know, we do a big job and they say, we'll pay you in 30 days. When we do the job, when our customers receive their food, that's when we record it as revenue. Expenses, when we incur them. When we know we have an expense, then we should record it. So if a plumber comes in, does a bunch of work, hands us a bill, whether I pay him today or I pay him 6 months from now, I need to record that expense today because I incurred the expense today. I owed it as of today. So that's the big rule for the profit and loss. Again, assuming that you're accrual accounting, which most of you will be. Okay, so matching principle explained. So let's talk this a little bit further, because here's where it sort of gets complicated, right? In the accounting world, most of the information that we have about your business is off of the bank statements, right? So if I didn't have access to your your POS system, let's say, or you don't have a POS system, or 50 years ago when everything was on hand, it was sometimes really hard to get to what we actually earned separate from the cash received. And here's a few examples of why, right? We received $10 because we sold 10 cups of lemonade at $1 each, right? Well, that's hard to easy. I have the $10. But my deposit was actually $12.65, because included in those sales were also sales tax that I collected and tips for my employees. So if I didn't have any other information, or 50 years ago when everything was just on hand, it would have been easy to say, oh, I earned $12.65. but I actually didn't earn $12.65. I earned $10. The other two will be items that I have to pay out either to my employees or to the government. So in terms of my cash receipts, they're going to go two places. The sales tax and the tips are going to go on my balance sheet, right? Those are those liabilities that we talked about last week. The $10 is going to go on my P&L. So this is where it's really important, especially even if it's just at the end of the year, run what your QuickBooks shows for revenue and compare it to your POS, because you want to make sure that what you're showing as revenue doesn't include things like sales tax or tips, right? It should match your sales for that period. And again, in terms of format, we could break that out into different categories of sales. You know, we want to have our accounting reflecting what we look at in the restaurant. So if you're looking at, you know, your food by category, then you would probably want your QuickBooks file or your accounting file to show that same revenue by category. Does that make sense? Okay, so again, what we always want to have is our POS to match our P&L to match our POS system, or however we can validate that revenue, not just our cash deposit receipt. So if you don't know how to do this, what I've given you is an example of a journal entry, how I would post it. Again, you know, whether you ideally want to post your sales daily, weekly, at a minimum, but you would want to record, you know, food sales and beverage sales. Those are all going to be credits. You have your sales tax, your tips payable, and then how I like to do it in terms of the collection, because again, some of it we have today, some of it we don't, would be the cash deposits and the credit card receivable into two separate accounts. The credit card receivable, I like to separate because then we can see how much actually comes in from the credit card, if that makes sense. So if you have any other questions on this or want another sample of a journal entry, but you know, the slides are also posted on our lecture, but it's good to just kind of work out what the journal entry should be, and then we have it moving forward. Okay, so again, P&L and versus my balance sheet, so my food sales and my beverage sales. Why am I recording $25 when I only received $14 today? So again, going back to my journal entry, of this $25 of sales, I've actually only have in hand my cash deposits. I don't have that credit card receivable yet. So why am I recording it as sales? Again, it's when we earn it. So that's the big thing. All my revenue should be when we earn it. Another example to think about for those of you that do catering, you do also receive deposits in advance. Those should also not be revenue until you earn it, because what happens if somebody cancels, right? Things like this. All of a sudden, those parties that we had booked, they now may have canceled. And if we have a policy where we will refund it, then that would be something that we have to do. So those are not revenue until we perform the job. In the deposits case, again, feel free to reach out to me directly if you have any questions on how to set this up. But the deposits are also actually a liability, because until we earn it, there's a chance that we won't earn it, which makes a liability. So again, that gets a little convoluted. If you have some catering questions and stuff, I can talk you through it. But just think of it as it's not revenue until we earn it. Okay. So again, our matching principle, the goal of the P&L is to show how profitably we are during that, whatever that time is, that day, that week, that month. We want to show revenues matched against expenses, regardless of when the cash is received or the cash is paid. So let's go through our expenses using the matching principle. So here, let's say I'm looking at my week, I'm looking at my bank statement, and I'm like, oh my gosh, I spent $55 this week, right? That's the cash that went out. Well, that's because I paid my payroll, I had my insurance, maybe a policy for a year, I also had a payment to my mom from the lemonade stand, and then that means that's my total cash out. So all of a sudden, it's like, oh my gosh, I lost all this money because I paid all this cash out. But what we want to do is make sure that we have that cash recorded in the right places so that what's on my P&L reflects my expenses for this time period that I'm looking at. So again, I paid $10 in payroll, but that included tips. So I had $8 of expenses, and $2 of a tip liability. So again, going back a little bit to anyone who did view the lecture on the PPP that has recently come out, this is an important thing, because if you were to pull your P&L for last year, if you are someone who pays out tips through wages, chances are what you show as a wage expense is less than what you will receive for those 2.5 times your total wages because of the tip, right? In the accounting world, those are not an expense because you are taking in the cash for the tips and then you're paying it out to your employees. So it actually is never earned by you because it's not money to you, and it's not an expense to you because really you're just the middleman, right? You're collecting the tips and then you're paying them out, but it's not earned, so therefore it doesn't go onto your P&L as revenue, and it's not an expense because it doesn't belong as, it's not part of operations, right? It was your employees, it's their money that you're flowing through. So again, that hopefully that makes a little more sense. But think of it, it has to be, you know, part of your operations as an expense, not just the go between. Sales tax do the same thing. You didn't earn it, right? The person paying the sales tax is actually paying the government, not your business. So you didn't earn it when it came in, and therefore it's not an expense to you when it goes out. The next one to go through would be your insurance. So a lot of times we pay insurance in advance, right? We have to pay in advance for 1 year, we pay in advance for 2 years, maybe 6 months. So what we don't want to do is just record that expense in the month that we incurred it. And the reason is because it's for a longer period of time. So unlike the tips where it's a future liability, I have to pay it out in the future, what this is actually an asset. That means if I pay today for a year of insurance, I don't owe insurance for the rest of the year. So that has future value to me. So my insurance is actually going to be part of what we call a prepaid expense, which is exactly what it is, right? I paid today so I don't have to pay tomorrow, which is going to be an asset. So if I was looking for just this period, what I would want to do is break out the insurance policy over the time that it will cover. So if it covers a year, I'd want to divide it by 12, 6 months, divided by 6. For this month, I only want to take 1 month portion of that insurance policy, and the rest then will sit as an asset because, again, it has future value, and each month I will use up a portion of the insurance until it gets to 0. And the last one would be payment to a mom, so similar to any debt payment, right? It's not an expense, and the reason is that you are paying down a previous liability. So it wasn't revenue when the money came in. So any loan, it's not revenue when it comes in because I didn't earn it, right? This is a liability. Someone gives me $10,000. I know I'm going to have to pay back that $10,000 in the future. That is a balance sheet transaction. It's going to be an asset in cash of $10,000, and it's going to be a liability of $10,000 because I have to pay it back. So I didn't earn it, therefore it's not an expense when I pay it back. The only portion of this that would be an expense would be interest. And the reason is, someone loans me $10,000 at 5% interest. That means I'm going to have to pay back more than the $10,000, right? I'm paying back the $10,000 plus interest. So that interest is an expense, and we would want to record it that month or that year whenever the interest is incurred. So that means of this $55 of my cash that is gone, I really only have $11.33 of expenses, and the rest is on my balance sheet. So again, this isn't like, we're not making the numbers better. We're not like smoothing earnings. We will record that additional insurance when we use it up, right? So over the next 12 months, we will record the full 40, but the goal is matching. So I want to see how my business did today, which means I have to do all of these little things with my insurance policy and all that, so I have the best picture of my business's outcome for today, looking at the expenses incurred today. Okay, so again, what about the expenses I didn't pay for yet, right? So the first piece here, we're just looking at my cash out. I'm looking at my bank statement. And I'm going through and I'm seeing what goes as an expense, what goes other categories, right? So that's the first piece. But then what about the expenses I don't even see yet? So these are the ones we also want to make sure that we are capturing when we incurred them, not just when we paid them. So the big one for everyone in the restaurant business would be invoices, right? Just to make sure that your invoices are always dated on the invoice date, because that is when it's incurred, not when it's paid. So the other thing is your inventory, right? Because if I purchase, so say I purchased $10 of lemons, the payment is due in the week. The first piece is I need to make sure I capture that expense. The second piece is, should that full $10 go on this week's P&L? Maybe, maybe not. That's where inventory comes in. So all of the harping of you have to do weekly inventory, it's so important. Here's why. Otherwise, you're showing $10 as a cost of goods, where you may have half of it sitting in inventory to be used next week. So it's really no different than the insurance policy, right? If you're buying supplies today, but you're going to use the supplies over the next month, you don't want to record the expense of the supplies today and then nothing the rest month. So that's why, as much as we can, getting this matching to work will give us the most accurate picture on the P&L. And again, cash flow will come. This isn't saying we don't care about the cash. This is just what the P&L, what we want the P&L to be. So again, inventory becomes critical, right? Because we want to see, of my $10 of purchases, of my $5,000 of purchases, how much do I have left, right? How much did I actually use this week? Because then we know where our buying is, how much inventory we have. We can actually track how much what is the value of my inventory on a given week. This is critical with liquor, right? Because that doesn't have the same waste, spoilage, use up, not use up. So really making sure we're doing good inventories is so important for the accounting of our business and understanding the cost of our business. So again, we would want to know how much we made, if we're doing a lemonade example, how much we sold, and how many do I have left. So in this case, if I have 2 lemons left on the shelf, then I would add, or $2 of lemons left on the shelf. Now here's what my P&L looks like, right? And again, keep in mind, my cash flow was very different. I would have my $25 of revenue. I would have $8 of cost of goods sold, because again, I have $2 of lemons left in inventory to be used next week. I had payroll of 8, even though I paid 10, 2 which were tips, and then I had the portion of my insurance. So now I feel comfortable saying, just based on this week, and again, we'll get to cash flow, but just for this week, this is how my business is operating. Okay, so again, some of the things we want to follow with the matching pencil with expenses would be always by invoice date, not by due date for our invoices. Expenses paid for multiple months. And again, you, the owner, know a lot of these offhand. You know it's the property taxes, you know it's the insurance. Those should always be divided by the number of months covered. That way we have the same each month. And then we would want to, at the end of the month, review our payroll days, just to make sure that our labor reflects the number of days in the period. So if you're not doing an accrual at the end of the month, which is how we call, moving the payroll days into the right month, and making sure that if we had, our first payroll of the next month really was this month's payroll, we should be making an adjustment so we have that correct amount in our payroll. If you're on a bi-weekly payroll, there are a few months in the year that you actually have 3 payrolls. So this becomes really important to make sure on those months especially that you're making sure your payroll reflects the day's work, not when the payroll was paid. Okay, so now that we have those rules, hopefully that helps us take a look at the P&L for the Cheesecake Factory, because it's the same, right? Whether you're a lemonade stand or you're the Cheesecake Factory, these rules are the same. And now that we've covered the balance sheet and the P&L, we should be able to go into cost of goods and inventory, right? Let's see, did their inventory go up this year or down this year? What was their cost of goods margin? What's their labor? All of those things are still the same. And they do all of those things that we just talked about. They go line by line. When I first started in accounting, I started off an audit. And really an audit of a big company or public company is going line by line and figuring out Is there an insurance policy? What are the months that are covered in this insurance policy? Do I need to move some of those months into next year? What about payroll? What was paid in January that's really a December expense? Because one of the things, if a company's trying to make their earnings look better is to not cut any checks in December. Wait till January and cut all the checks. So as an auditor, you should go there and go all through all the January expenses. You're like, oh, yep, that was a December bill. That's a December bill. So you see that a lot at the end of the year. And hopefully now that we've covered more of the matching principle, it makes sense why, right? Because they don't want those expenses to show up in this year. They want it to show up in next year. So, yes. But this is where, really understanding what are the areas of the matching principle that I need to look at. Because for us as the owner, we want every month to reflect the current month, because then we are going to have some really good information on trends and changes. But without the matching principle, it would be hard because you may have some of these, expenses that come through every quarter or every 6 months throwing off your bottom line. So for the Cheesecake Factory, this is what it would look like for 2018, 2017. They actually also gave us 16 in the financial report for 18, so they gave 3 years. You could actually do this over 3 years if you want. But a lot of times what I think is to break it down into percentages. So for me, I like looking at a P&L by percent, because if you just look with dollars, it can be hard, especially in restaurants, because your revenue is always changing, right? It's not like you have the same revenue every day. It always is different. So I think the percentages kind of help us drill in a little bit. So if we took 18 and 17 as a percent, and you would see some changes. So again, cost of goods is 23%, which is very good. I think all of us would say that's a really good number. But again, they have a lot of volume, so I'm sure their pricing is very good as well. Their labor is 36%. So if we went that prime cost with the goal of 55%, they're right there, but their labor went up a little bit. So if we were looking at this, we may want to figure out why their labor went up a little bit. Again, sometimes it could be a bonus, the decision to pay out your employees more in a bonus to incentivize them because their sales did go up. So that could definitely be the case. But there could be other things, labor rates. And they're in California. California had that increase this year, so that could be the case as well. We then have our gross profit operating expenses, which stayed the same, and then the operating income of 5%. So, again, just I think the percentages help us, and these are good numbers, but I think they probably are some things that we want to look at and see what had changed. Because if you look at 16, I think 16 was a little better than 17, but the revenue is growing. So they're also a little bit in growth mode, which could also explain why the net income went down a little bit. Okay, so looking into my P&L, what you may want to do for your own P&L is really break out the different revenue centers that you have in your business. So if you have one P&L for, say, 2 locations, you would probably want to see if you could do this by location, because again, that matching principle and really analyzing the performance of the business, you want to make sure that you're looking at one business, one operating center if we can. So if you're using QuickBooks, it can let you do classes, and that's a great way because you can then see, this is my catering versus my restaurant versus my brewery, or location 1 versus location 2. It just helps because then you can really see the ultimate cost. And sometimes, especially in restaurants, it's hard if you have sort of a centralized production that's making food for both catering and the restaurant. It's really good to see if you can drill in on what's the ultimate cost of my catering, so I can see my margin on catering. And if I have only limited time, am I better focusing my effort on catering or the restaurant? And that's where it does help to break that out into the subcategories. And then each location definitely should be broken out into separately because they're different. So I'm sure in the Cheesecake Factory behind the scenes, they have this, every location has its own and sort of rolls up into one. So that would be very important. And then it's also important when you're looking at your P&L to make sure that all of those overhead costs are counted. Now, some of us may have a structure where you have an operating unit and then you roll up into sort of a parent company. you just want to make sure that all those operating costs on the parent company side are getting accounted for some way as part of your overall organization. So you may have to run, you know, a consolidated P&L with those two combined to really get that true net income. Okay, so for the Cheesecake Factory this week, you know, we do have 3 years of data. So one question would be, what has changed in the last 3 years? And, you know, we all know that the climate for restaurants is very good in the last 3 years. So are they reflective of that? Does it look like other things are happening in their organization? Which was their best year and why? And what can we learn from the management report at the beginning about the last 3 years from the management perspective? So hopefully this exercise is starting to make a little more sense of these financial statements. It's definitely time well spent, because I think, as you'll see, we get comfortable every time we look at them, right? Take some of that fear away, because, you know, when you actually just start looking at these statements, they're not so bad. And we all know it. That's the fun thing. It's like, you know so much about this. It's just kind of taking what you know and then just looking at, you know, the P&L and really digging in. But hopefully these rules have sort of helped plant a great seed. Next week, we will be doing the cash flow. So again, don't think that, you know, when we're talking matching, that we're getting rid of those cash payments. It's separate. So the third piece will be our statement of cash flows. So I look forward to joining you next week, and please feel free to reach out if you have any questions.